Hi, everyone. Good evening to all of the attendees, Y Associates leaders, and fellow agents. My name is Hari Raj, and I will be sitting in for Kaming today, who was supposed to MC, but unfortunately can't make it today. Thank you for joining us in our Money Matters webinar, where we will be focusing on how to make money work smarter with insurance plans. In today's webinar, we will be playing a pre-recorded presentation by Kelvin and Elaine Koch, which will be followed by a live Q&A session. And following that will be the Y Associates Bonanza Lucky Draw giveaway. Without further ado, let me first introduce the speaker of the day. Kelvin Koch is a wealth management manager and also a unit trust managing advisor. His key expertise include legacy planning, investment portfolio building, and income protection. Being a certified financial planner and holding a master's in business administration, coupled with 18 years of industry experience, has enabled him to provide trusted advice to his clients. Being a constant achiever in both insurance and unit trust has resulted in him achieving his $1 million roundtable for the past 3 consecutive years. Please enjoy Kelvin's presentation.
Thank you, Kaming, for your kind introduction. Good evening, ladies and gentlemen. We're now going to look at the topic of, are insurance products a viable choice? If you look at today's environment, what we're looking at is there are many products vying for our attention, right? If you look at the market, you have your very basic savings and fixed deposits, which is the simplest form of products. Then there are insurance products, insurance savings products. You have unit trust mutual funds and shares, and the more exotic like derivatives and cryptocurrency. All right. In order to understand the current environment, let's take a look at the interest rate. Okay, this is the chart of the Malaysian interest rate for the past 20 years. Malaysia has been running in a very low interest rate environment. If you look at the chart for the past 20 years, okay, it has risen to a high of 3.5% back in 2007, but moving forward, it has stayed low, and due to the recent pandemic, the COVID-19, interest rate has dropped to the lowest in history, which is 1.75%. Okay, this is very different from the heydays back in the late 90s and early 2000s, where interest rate was up to double digit. So what does this mean? Okay, if you are a borrower, right, you're taking a loan to buy a house, a car, or even to finance your business, that's good news for you. Why? Because you're paying very low interest rates. But if you are a saver or an investor, this is not so good news. Reason being, at this low interest rate, whatever interest or returns that are being paid will be much lower. Okay, this is the most recent savings account rate being paid by Maybank and Public Bank. If you look at the rates, they are only paying about 0.25% for Maybank, and for Public Bank, they're even paying as low as 0%. So in other words, you're not getting paid, to save your money. All the other banks in Malaysia are offering more or less the same rates. So a savings account technically now only functions as a place where you want to store money temporarily for your daily expenses. Because if you store all your money in there, you're not going to get much out of it. At 0.2%, you're really almost getting nothing, right? Okay. This the latest interest rates for FDs at the various banks in Malaysia as well. The 12-month FD rate varies from 1.6% to 1.8%. Okay. So what does this low interest rate means to you and me? It means that, okay, say that, you put 100,000 in the bank, right, in a savings account. What do you get after a year? At 0.25%, you get 250 ringgit, which is like, you can hardly do anything with that, right? Because translated, if you divide that by 12, you get like what? 21 ringgit a month to spend. And if you want a bit more, you put in an FD, right? You put in 100,000, you get 1,008 after a year. Let's consider the situation of a retiree. If you're looking back at 25 years ago, FD were paying like around 5%. So if a retiree puts 100,000 in the bank, at the end of the year, he or she will get 5,000 extra to spend, right? But today, putting the same 100,000, they will only get up to around 1,008 to spend, which is a very significant decrease. It means that compared with 25 years ago, that person only gets to spend a third of the money. And if you really think about it, that 1/3 absolute amount, that person don't even get to spend that kind of amount. Why? Okay, let's look at the next slide, right? Another very critical factor here is over the years, you have what they call inflation, where the price of goods goes up, meaning that the cost of living goes up, right? This is the official statistics of Malaysia, right? Ranging from 2003 to 2019, okay? If you look at the numbers, year 2008 was one of the higher jumps with 5.44% officially recorded. But as everybody knows, the official inflation rate of Malaysia does not tally with our personal inflation rate, right? 20 years ago, somebody in KL having a bowl of noodle will cost you what, 4 ringgit? But the same bowl of noodle today costs you about 7 to 8 ringgit, which is almost 100% jump, right? So going back to that example of having this person only making a third in interest and factored in inflation over that same period of time, the amount of interest that person can spend is actually a sixth, right? That is a very serious decrease. So therefore, everyone is actually looking for alternatives, right, to give you better returns. If you compare the actual personal inflation against the Malaysian official inflation rate, what you have to do is like, first, look at how much you're spending, right? It's best if you actually do keep like a ledger of your expenses to know that year on year, how much money are you actually spending more, or how much more do you need to spend in order to buy the same goods against our official inflation rate, right? This will actually show you that if you were to actually follow what the official inflation rate that is published, you're going to end up in a very sorry state. Because why? One, you will keep spending more because thinking that inflation is not that serious, right? But if you were to actually look at what you actually personally spend and how much it has increased over time, you would actually budget more carefully, right? And given that currently it's a very low interest environment, meaning that whatever money you actually save doesn't give you that much returns, you would even be more careful about how you spend it. And looking at the official rate, it can be very misleading. Like for the most recent years, as in 2018 and 2019, it is less than 1%. Okay, why does this come about? Our inflation rate is actually calculated based on a basket of goods that we all spend on. But most of these items that are placed in a basket of goods is actually controlled price items. So in other words, is the government actually sets a ceiling on how much these items can be sold at. So if you have 70% of it fixed, right, it means that they can always control and keep that low, while the other 30% are made up of items that fluctuates, but because they take a smaller percentage, the inflation rate is kept low. All right. To make sense of all the numbers that I've just presented, let's use the rule of 72. What is the rule of 72? The rule of 72 is a very simple formula to use to calculate how long does it take for the amount to double given a specific interest rate or returns. All right. Okay. Let's use an example of the FD interest. Right. Okay. Say the bank right now they are paying 1.8%. So 72 divided by 1.8. So it will take you 40 years, okay, to double that money. So in other words, is if you were to put that money in FD, right, it will take you 40 years to double your money. Say that this person puts 100,000 in the bank and the bank pays 1.8%, right? It takes you 40 years for the amount of money to reach 200,000. But let's take the inflation rate at, say, a personal inflation rate of 6%, meaning that using the rule of 72 and the inflation rate of 6%, it takes 12 years for the amount to double. So in other words is, if you put 100,000 in the bank, it grows at 1.8%, what do you get? You get 200,000 in 40 years. But if you were to spend 100,000 a year, right, at a personal inflation rate of 6%, it takes 12 years for the amount to double. So in other words, for the same amount of things that you spend on, it will cost you 200,000, right? And if you make the same amount of money, you'll be spending half of that, which is 50,000 in the 12 years to come. While many are not aware of the rule of 72, most have some sort of idea that, the whatever money they're making and the returns they're making are not keeping up with inflation. Therefore, nowadays you have a lot of people who are going into riskier investments without understanding the risks involved. There are those who goes into those money schemes, right? Some people try to go into like anything that comes along that pays much higher interest rate. All right. Now that we have established that the current interest rate environment doesn't interest most people because it's very low, we can now actually look at what kind of replacement would actually be more suitable to replace this kind of savings or FD investment. Usually people who put money in fixed deposit have a lower risk tolerance, meaning that they would prefer to put money into the instrument with zero risk and getting paid. They are willing to forego the higher returns by not taking on so much risk. But it has come to a point where the returns are much too low, and in itself, it is a risk. Because why? Low returns means that you won't be able to catch up with inflation. Every year, instead of growing, your money is actually shrinking. Looking at the current economic situation, interest rate is not expected to rise anytime soon. Why? There's a pandemic currently going on. It's affecting a lot of business who are running into like financial difficulties. So raising interest rate would mean that borrowing costs will increase, and therefore all the businesses will run into more problems faster, and most will be forced to shut down. So our interest rates are not going to go up because it will cause a lot more problems from there. Neither are interest rates going to be dropping any further because making cheaper, our interest rate has already dropped drastically over the past year, and they stopped reducing it after realizing that it has come to a point where further reduction will not stimulate the economy any further. And moving forward, because of competition as well from our neighboring countries, we cannot afford to raise interest rate or raise it fast. Why? Because if it raises fast, our country will not be competitive because our cost of doing business here will increase. So therefore, I can see that interest rate is going to be pretty much staying around about the same in the long time to come. And therefore, if anybody who's looking for alternative place to put their money other than savings and fixed deposits, they can actually look into insurance savings. Why? Insurance savings is it's a low risk product, but at the same time, it's a slightly different kind of thing. Why? Okay, a lot of people are not too keen on insurance saving prior to this because it requires them to lock in their money for the long term. Let's look at a comparison between savings in the bank and savings with insurance. As you all know, a bank savings makes withdrawal very easy because by nature it's designed to make putting in money and taking out money very simple, right? All you got to do is like go to an ATM, right? Put in your card, key in your PIN, just put the amount of money you want to withdraw. Or in today's world, it's even easier because why? All you need is a phone. Just log in and do whatever transfer or payment you want as well. So money actually flows out of your savings account anytime you want, right? If you, let's say you go make a purchase, right? Any amount of money, you just go beep, swipe, pay, right? Okay, insurance savings on the other hand, it's easy to withdraw the money, but there's a few more steps involved, meaning that you actually have to go to the insurance company and put in the request. It might be a bit troublesome, but the process itself usually allows the person more time to think about withdrawing the money. Why? A lot of people, they most often withdraw the money because they want to buy something on impulse. So having a bit of cooling off period or cooling off time between getting the money, right? It allows them to think rationally. Do they actually need the money? So in a way, it actually helps a person not splurge or waste the money. Come to the second point. When it comes to distribution, if let's say something happens to that person, he passes away, right? A bank savings, which forms part of the estate, is frozen. So whoever needs the money the beneficiary will have to wait. Why? They have to go through the process of distributing the estate. If the person has written a will, then the person, they will bring the will to court and apply for probate, and they distribute from there, and it will take several months. But if that person has not written a will, that process can take years. Okay, so in other words, is all this money is locked up. But putting money in insurance, it will mean that upon anything happen to that person, the beneficiary will just need to go to the insurance company with a policy and all the relevant documentation, and the money will be paid out. Okay. Another point we want to look at is usually when a person saves money, right? It's because they want to achieve a certain amount over time. So for those who save in the savings account, right, in a bank savings, okay, usually what a person does is, every month when you get paid, you put aside, you sort of save aside a certain amount of money. Say that, this person, he wants to save up 100,000 for down payment for a house, right? So every month, maybe from his pay, he takes 1,000 and puts it in. It will take a certain amount of time, right? But 2 years into this plan, the person falls sick. He's not able to work. So what happens? Whatever money he has saved in these 2 years, which is 24,000 plus the interest, that's all that's saved up. So there's eventually a shortfall of more than 70,000. That in itself means that there is inherently risk involved, because why? There's always the risk of falling sick or being disabled, and you're not able to achieve your savings goal. Now, how does insurance saving help you in this scenario? Insurance by itself it has a protection. So in the event of falling sick or disability, there's a sum assured that will be paid out. So in other words, is say that a person wants to like save 100,000. So he goes, looks for his life planner, right? Plans out, okay, how am I going to achieve this, right? So the plan, what you do is like you pay for the plan. You can do it monthly. You can do it over whatever interval you're comfortable with, and it comes with the protection. So say after 2 years of paying, right? Say he pays the same 1,000. What happens? Disability happens. So there's a sum assured of 100,000. The insurance company will pay him the 100,000. So after only putting in 24,000, he gets 100,000. So in other words, is that savings goal can be achieved. Okay, next we come to returns, right? Traditionally, insurance savings has never been too popular. Why? It's the public perception that insurance doesn't give very high returns. Usually, they return about 4 to 5% annually. But given the current environment where banks are giving you what 1.6 to 1.8%, effectively, insurance is giving you almost triple the returns. So in other words, back to the rule of 72, it will take you 40 years to double your money. But putting in an insurance plan means that you cut the period short. Even if you're taking that, the insurance savings gives you a 4% returns, right? It will take you 18 years to double your money. So you effectively have shaved half the time away. So if you look at it this way, insurance savings is not as bad. Lastly, let's look at the payouts. A bank savings will guarantee you a payout at the end of the period, usually 12 months, right? But what they do not guarantee you is the interest rate. The interest rate fluctuates based on the prevailing rates, right? Insurance savings, on the other hand, you can find plans that actually gives you guaranteed payouts at a fixed interval. So in other words, is regardless of what happens, they still have to pay you that fixed amount. And at the end of it, they will give you all the promised payouts. Therefore, insurance savings can be a very attractive alternative, especially to those who likes consistent guaranteed returns over a longer period of time. Let's look at the pie on the left. It's a representation of commonly how people save their money. They usually have some money in short-term savings, long-term savings, and into investments. People normally associate savings in a bank as a short-term saving and in saving with insurance as a long-term savings. But in practice, a lot of people who actually put money in, like FDs, they actually do not touch the money in the short term. They usually just put it there and let it grow over time. So in reality, the FD is actually a long-term savings. So what you can actually do is change your way of thinking. So instead of putting so much money in short term, right, you can actually adjust it and shift it more to long-term savings, which in practice, most people actually do that. By moving more allocation to the longer term savings, you are actually practicing what is called delayed gratification. Okay, what is delayed gratification? In other words, is you are willing to give up spending. Delayed gratification by definition means that you are willing to postpone spending money on whatever you want now to a further date so that that money can be used to grow more. So in other words, is by the time down the road when you actually purchase the item, you would have more money left with you to do other things as well. While this thing is easier said than done, it is something that everyone should practice because we're living in a current world where we are actually spending money before we make it. So if we actually do control our spending habits, right, then we do not have to like end up with a situation where we have debts or even debts overwhelming us.
Right. For those of you who came in late, welcome to the Wai Associates Money Matters webinar. That was Calvin Koch, a leading life insurance and unit trust manager. I hope you all found that informative, as not every day we get someone with such specialties to come and speak with us. I know you have a few questions already, but before going to the Q&A session, I would like to play the presentation by Elaine Koch, who will be giving you an overview of A-Enrich Gold, which is an insurance saving plan brought to you by AIA. Elaine is a wealth management executive who not only has a master's in business administration, but also comes from 20 years of corporate experience, with key specialities in legacy planning and portfolio optimization. Elaine has helped a variety of clients protect their lifestyles and achieve financial independence. This has also led to her achieving several awards as a life planner. Please enjoy her presentation and remember to send in your questions so we can get to it in the Q&A sessions after this.
Thank you very much, Kaming, for your kind introduction. And good evening, ladies and gentlemen. Thank you for taking the time to be with us today. I'll be sharing about why you want to consider an insurance savings plan to complement your existing savings, as well as introduce to you one of AIA's savings plan. Insurance savings plan is actually complementary to all other forms of savings that you have, like your bank account, your FDs, your Amanah Saham, your unit trust. There's no conflict there. And it's very flexible because you can actually choose to top up and to withdraw. And you can choose whether you want to take the cash payout or you want to accumulate it into the plan. And it's very secure because you get protection in the event of death, disability, or critical illness. And it's very easy to distribute to your beneficiaries. It will not be frozen like your other savings instruments, such as the bank account, the FD, Amanah Saham, or unit trust. And there's also a guaranteed value there, as with all insurance savings plans. Why A-Enrich Gold? It's actually AIA's total wealth solution on part of it that helps to ensure unfortunate events won't actually destroy your financial independence. It's popular because it's flexible and it's secure, and it will complement your overall savings strategy, no matter which point of it you're at now. And there's also a Sharia compliant version where you can make use of the hibah component that we can discuss about later in the Q&A. For A-Enrich Gold, the unique key benefits to it, firstly, is the guaranteed cash payments. You get a percentage of the sum assured as a guaranteed cash payment from the inception of the plan. In the first 10 years of the plan, it will be like every 2 years you get 5%. And after that, from year 11 to year 20, you get 8%. And the final 5 years, you get 12% of the sum assured. And at the end of it, there is the guaranteed maturity value is 120% of the sum assured. In other words, with these guaranteed values, your capital is very safe with this plan. And the third key benefit is easy distribution, where you can nominate beneficiaries and the payout will be processed within 14 days. So it will not be frozen, and you can actually use it for day-to-day living expenses for the family, as well as to help with unlocking the will and all that. And fourthly is the insurance protection part, where there is a death and disability benefit where you get the sum assured, unlike other savings instrument where you only get whatever you have put in. And there's also double protection in case of accidental death or disability. The payout of the sum assured is double. And also, if in case of critical illness, there's the waiver, whereby you can stop investing and the insurance company will actually be continuing the investments on your behalf. So the plan does not get affected. And it's also multi-generational. It can span up to 3 generations. And then fourthly, there's the short premium term. So you only need to invest for 10 years. Because most people equate like insurance, there's a long-term investment. But this actually you invest for a short term and you enjoy the benefits, for the long term. And in terms of flexibility, when you have extra money, you can actually choose to top up. And in case of you really, really need money, you can actually withdraw, because there's the A+ enhancer component for you to do that. And you can also, using that component, take advantage of AIA's investment funds, where you can enjoy potential investment gains. So these are the 8 benefits unique to A-Enrich Gold. next thing is, it's also highly customizable to meet your specific needs. Yeah, for example, a grandparent might want to leave legacy for grandchildren. Say you have a fixed amount of money, but you can choose to invest it into this plan where, right, you can still use the money for yourself and at the same time leave a legacy for your grandchild. And you can also use that for retirement planning to actually supplement, right, whatever you're getting from EPF or even other sources, because this is a guaranteed amount that you're getting. And you can also use that for education planning, yeah, whereby we are not talking about like taking out a lump sum of money at 18, but rather, right, whatever you have already paid for, it can be replenished, where you can use it for the next child or even to fund postgraduate educational needs. And other than that, there's also like medical funding. Some people actually use it to pay for their medical because, as you know, right, when it comes to medical, you have to continue, right, paying for it in order to enjoy the benefits. So what happens like after retirement and all that, right, when you have lesser income? So people actually use insurance savings plan, right, to help fund their medical policies. And you can also use that, right, to fund like, special dreams that you have. Like some people actually like plan for their 25th wedding anniversary. So, after getting married, then they start such an insurance savings plan to work towards that goal. So it can be anything, right, that you have in mind. All you need to do is just contact your life planner. We will actually have a promotion running now. There's a complimentary consultation that takes about 30 minutes where we'll give you a financial health check. And also, right, your life planner can help you to outline the short, medium, and long-term goals, as well as propose solutions, right, customized to your needs. Because life planners here at Wai Associates, right, we work in a team and we actually have like certified financial planners that will also help to give advice. Yeah, so you can be assured, right, that your life planner comes with professional backing. Yeah. And also, right, you can take this opportunity to share about, this complimentary consultation with your friends. Yeah. I'll pass it back to Carming now before we go into the Q&A session. Thank you very much.
Okay. Thank you, Elaine, for that presentation. So now I'm sure you have a lot of questions you want answered. So joining us live for this Q&A session will be Kelvin and Elaine. Hi, Kelvin and Elaine. Can you hear me?
Hey, hi.
Kevin, can you talk using Elaine's one?
Yeah, just give us a few seconds until Kelvin gets on their laptop.
Yeah.
Sorry for that.
So hi everyone, good to see you all here. Thank you so much for joining us here today. I'm Casey, and on behalf of Wai Associates Agency and our team, we want to welcome you. So what we have today is something that's very special, and I hope that you will enjoy it and also ask as many questions as possible. So we're going to try to have a bit more Q&A talking session this round, right, Harry? If I'm not mistaken.
Yeah. That'll be better so we can answer their questions as well.
Right. So we try to run it a bit more casual. While Kelvin is trying to get his internet and Elaine to get their speakers working and their mics, perhaps we can look at some of the polls and discuss it first. How about that? Yeah. So
Yep, sounds good.
Some of you have answered the poll already. We have about 41% of people answer the polls. If you don't mind, it'd be kind of cool that you can answer your poll now. It's popping on your screen, just so that we can talk about this issue. Those who have not answered the poll, please answer. Don't worry, it's 100% anonymous. It just helps us to tell us about how many people have voted for this. I think the poll questions are popping on the screen. You can click it there. That way we can, it'll be quite an interesting statistic for you guys to see. Yeah. Good about.
All right, I think Kelvin is back on.
Oh, okay, Kelvin.
Hi, Kelvin. Can you hear me?
Hey, can you hear me?
Yeah, much better
Yeah.
now.
That's okay.
Okay. So yeah, we have a few questions ready for you actually. So okay,
cool.
let's get into it. So the
You guys
first
just let
question
me know.
here.
Sorry, Harry. You guys just let me know if you want to end the poll. Those who haven't done the polls, last minute, do it now. And after when you're ready, I'll end the polls and we'll show the results of the polls. Yeah.
Okay, great. All right, after the
Okay.
Q&A, you can just end the poll. All right, okay. Here, Calvin. So the first question. What will happen to my savings if I surrender the policy, especially when I am in need of money? So
Okay,
basically, what happens if I need to surrender the policy?
Okay, it will depend on exactly on which year you surrender. Usually, insurance plans, they're actually designed for longer term savings. So there's always penalty involved if you were to withdraw it early. But remember earlier in my presentation, I was actually recommending that you move a bit of your short-term money to your long-term savings. So technically, that money, right, you wouldn't have urgent need for it in the short term. So what you do is you actually divide your money into three different segments. Short term, longer term, and into investments.
Okay. So I hope that answers your question.
Wait, Kevin,
so
Kevin.
Yeah.
I just wanna add on a question to that lah. Like you said, you should break it down into percentages between short term, long term, and investments, right?
Mhm.
What would your advice be in terms of percentage breakdown? Just curious. Yeah.
Okay. That one you actually have to sit down, right, and actually find out exactly does the person have what his goals are, in the immediate term, intermediate, because why every person will have a different ratio depending on what they have planned.
Okay.
Okay, there's no such thing as a one size fit all.
So Kelvin, are you suggesting that it will be a customized for people depending on their needs?
Yes. Okay. Basically, the analogy is very simple. When you go see a doctor when you're not feeling well, right? Okay. Does the doctor actually, ask you questions, go through the diagnosis and everything before he prescribes medication, or you come in, he takes a look at you and he say, okay, that's it. I give you a medication, you're done.
Not
Right.
the quite first. The ones that are not qualified. Yeah.
Yeah, I mean, that's the truth, right? Would you have
Yeah.
confidence in someone, who just says, this is the magic formula, I just give it to you and you're going to be perfectly cured?
Well,
Right.
that's kind
Yeah,
of
of course
scary.
not. Of course not.
Yeah, but that's how a lot of insurance agents are approaching their customers today. What are your thoughts on that? Is that our approach? Is that how you do with your clients from an investment expert? I mean, I'm asking this because Calvin's an investment expert with over 15, 20 years of experience managing a total asset portfolio of over 20 million ringgit for his clients, personal clients. So yeah, so he's also a CFP. A certified financial planner, and also an MBA. He's got all these titles here. So let's hear from that perspective. How does it come? Because a lot of insurance agents will come and say, hey, my savings plans are good and things like that. How would you answer that?
Okay. Personally, I mean, I've moved away from all this product pushing, because the problem is whenever you just come and tell somebody that my product is great, but the problem is it's great. What does it do for me? Right.
See, I see.
Right.
Okay.
Another thing you have to look at is back to the same analogy when you go see a doctor. I mean, this person might not realize exactly what problem he has, but he knows that he has a problem, right? So you actually have to go through the whole process of finding out, what the person actually wants, right? And at this current point of time, what he has at his disposal, right? What can he do basically with what he has, right? How he can reallocate his resources so that he can optimize and best get better returns out of it.
Okay, cool. Thanks for answering that, Kelvin.
Yeah, thanks, Gavin. Okay, so yeah, we will go to the next question here. It's regarding a trust deed. Are you able to advise the potential and risk for investment in trust deed as compared to other investment portfolios in the market currently?
Okay. Trust deeds are, as far as I know, they are relatively quite a new thing, right? So, what exactly the trust deed is? We'll have to look at all the legalities written into the trust, because I cannot exactly tell you. It's the same thing like looking at any investments, right? You have to look at exactly what is written, what their intention are, right, and how it's supposed to be managed, and what kind of charges and all, and what kind of payout they will give you.
All right. Okay. So that question was from Jusri Ong. You can let us know if that has answered your question or if you have a follow-up question to that.
Yeah, we can actually unmute Jusri Ong to chat. if you
Okay.
want.
Yeah, he just replied yes, thank you.
Okay.
Okay, that's great. So there's another question here. If retirement is coming in 5 years' time, what kind of finance planning is suitable, if there is any?
Okay, retirement is coming in 5 years' time. All right.
Yeah.
Usually, well, this is going to require something drastic. Okay. We're gonna have to look at a few factors. First of all, we're gonna have to look at how much retirement savings you have saved up, right? And we're gonna have to look at your current lifestyle, right? So basically, working on a few numbers like that, we're gonna have to we can actually get an idea of whether you will have enough money to retire. So if that number meets your requirement, then you can plan to retire in your 5 years. But if that doesn't happen, right, you might have to think about extending your working years.
Okay. So I think
I
I think the main thing is getting a financial health check from your life planner, I guess.
I can't just give you a straight answer, because seriously, you're gonna think I'm a quack.
Yeah, of course. I think it depends on how much finances they have and so on.
Yeah.
Yeah.
It's basically like looking at a what do you call that, a business report. You want to see whether a company is healthy or not. So you really have to have the numbers.
True. That's very, very true.
I must add on that you can always contact your life planner who's invited us here. And I think special for today, it doesn't matter who your life planner from Wai Associates team is. Kelvin will personally look into it, the numbers for you if you want to, just for say. Yeah? Special.
You better take the
Normally
opportunity.
he charges money, but I think today it's okay. He's quite expensive.
Right. Okay. So we move on to the next question here. By Uriteran. I missed the one. Okay, so his question is, can I know the interest rate of insurance saving plan? So I think that's very general, but do you have an explanation for that?
Okay. Generally, the insurance savings plans in the market, right? They can return anything between 3 to 5% per annum over the duration. It's about 3 to 5% per year over the duration of the policy.
Yeah. Okay. I hope that answers your question, Return.
Is that a fair rate? I mean, comparing it to safer kind of investments, Kelvin, in your opinion, sometimes our clients ask us about, oh, I can go into, bonds, I can go into things like that for savings, how would you answer that,
Well,
it's 5%. Last time people used to say it's bad, but of course now with FD rates so bad, this is better, right? I mean, can you share your thoughts on that?
Okay. Again, all these instruments that everybody wants to invest into, right? Okay. First of all, it depends on how familiar they are with these instruments, right? Because things they are familiar with, you are comfortable with it, right? Also, another thing is like you have to weigh the pros and cons, right? Okay, a bond fund is good. I mean, it's liquid. It gives you pretty decent returns, right? Of course, it does fluctuate. Okay, there's always the risk of what do you call it, bond the bond company defaulting, right? But in a bond fund, is usually not a very heavy impact because why? It usually comprises of up to about 5% of the entire bond maximum, right? But again, why do people put money into insurance savings? Because okay, insurance saving as its insurance, right? It comes with a component of easy distribution and protection, right? So in case unfortunate event of the person either falling sick or passing on, right? The payout is actually higher, which in a regular investment, right, you don't get it, right? You get exactly how much you put in, right? Another thing will be from a distribution point of view, okay? Other than insurance, right, other asset classes will have to go through the distribution process, meaning that you have to go to court, you have to get a probate or an LA, right, before you can distribute it. But prior to that, you do have to clear all the debts in the estate. But being an insurance product, right, it can be, this money can be given to the what do you call it, the beneficiary right away without going through all those hassle. All you gotta do is just complete the paperwork, submit it to the company, and within like 2 to 3 weeks, you get your money. Does that help?
Yeah, I think so. Seems to answer that. By the way,
All right.
how about for Elaine has been here as well. She's also on. Harry, you got anything?
Yeah. Yeah, Elaine. Okay. So I have another question here. Oh, sorry. I have another question from Justri Ong. Does insurance saving plan have income tax waiver when submitting our tax return on an annual basis? If yes, which category? I think Elaine, you can answer this.
That would actually be under life insurance.
Right. So the income tax is only under life insurance.
Yeah. A-Enrich Gold, right? It's under
Yeah.
life insurance.
Okay. All right. Okay. Thank you. Okay. And then I think we have time for one last question, and then we'll move on. What are the risks involved in the insurance, in investing in insurance, and what are the chances of losing the investment?
Okay, the question is directed at me or at Kelvin?
Elaine, you can take this.
Okay, essentially, right, any form of investment, there will always be a risk element. But our life planners will actually discuss with you first, what is your risk appetite before we actually make a recommendation on the funds that you put in. But because it's an insurance savings plan, only 30% of it goes into the actual investments. The rest are guaranteed. So in other words, right, your capital is more or less preserved. So you run a much lower risk compared to other forms of investment.
Okay.
Harry,
Right.
some polls here.
Yes.
Do we want to quickly just run through the polls?
Sure. We can just put it
you
up.
guys see the polls, yeah? Maybe we can quickly run through the polls as well. I think very interesting. You want to read out the results and?
Yeah. So the poll is.
Yeah, can you see it, or I can read out the results if you want?
Okay, so yeah, I've got the results here. For how much total savings do you have? In the poll, the answer was 63% put below 50,000.
Wow.
25% put 50 to 250,000. 6% put 250 and above, and 6% put 500 and above. So that's a very big percentage which has a savings of less than 50,000.
Maybe we can ask our experts, Kelvin and Elaine, what are their thoughts on
that?
I was quite surprised by this poll. Very surprised.
Yeah, Kelvin, you want to go first, and then we can come to Elaine after that.
Okay, that's not a very surprising number because it's pretty much in line with the EPF statistics.
Oh, ouch. But how is it from a financial view? I mean, is this healthy? I mean,
okay, having less than 50,000, it will depend on the age, of course, right? If you're closer to retirement, that's not very good, right? It means that you really either have to work very hard, find some a second line of work, or maybe change jobs, right? That you better. if you're still young, right? You're beginning. Yeah, you have plenty of time, so there's not too much to worry about. Overall, maybe you should start looking at actually start tracking your expenses. Doing a budget and all, so that actually you can increase that number.
Okay.
Because
Elaine, do you have
if you're young, right?
Yeah, sorry, Calvin.
Yeah, no, because for young people means they will have a lot of plans coming, like getting the house, getting married, having children. So
Yeah,
it's
of
always
course.
best to have a bit more cash on hand.
Yeah,
Right.
that's true. Elaine, do you have anything you want to add to that?
Basically, I agree with Kelvin because it depends on like what life stage you are at, how much is your income and your expenses. Then only we'll know whether your situation is like safe or is it critical.
Okay.
Just to add in, if any of you are below the age of 50 and probably around 20 years old, we have the fantastic career. We are recruiting. We're always looking for good professional life planners to join our team. Of course, all of them are very good looking. You can see them here, even the ladies and the men. And the ladies are very pretty. So do remember that if you find your savings rate too low and you don't know how to achieve your dreams, do contact your life planner. We might have the career opportunity for you. Okay, so it's more about making income only you can save. Sometimes if you're in the wrong career, you have no income, you also cannot save. I think we get a problem also. Yeah. So anyway, back to you all. Yeah, back to Harry.
All right. Okay. I think so. That's all for questions for today. Thank you, Elaine and Calvin, for the presentation and answering the questions. We really appreciate you being here today. Thank you so much. So now we will move on to the next part of the webinar, which is the much awaited for Wai Associates Ambassador Lucky Draw. So for this, I would like to invite the chairperson for the Wai Associates Lucky Draw Bonanza, Hafiz. Welcome. The floor is yours.
Right. Thanks, Harry. Okay, so before I start sharing on this Wai Ambassador, I just like to recap what Wai Ambassador program is all about. So if you can you see my screen, Harry?
Yep, you can see your screen. No
All right.
Yep.
Right. Okay, so just to recap, what is Wai Associates Ambassador Bonanza all about? So basically, we are here. We want to, reward our clients who refer us contacts, irregardless whether that person, purchased or not any insurance policies from us. So the idea was basically every person that you refer to us, every person, your friend, relative that you refer to us, you will be entitled for one lucky draw. And it was actually supposed to run for the whole of Q1, which is from January to March, but we actually extended it until 30th April, which ended a few days ago, right? And also in the month of March and April, we did run like a special promotion where if a person that you refer purchases a policy, you will get extra 5 entries, right? So just to recap the prices. So in January, for those who referred to us in January, we have already given out prizes of Airport, Fitbit Inspire 2, and actually Touch and Go gift vouchers worth 200 ringgit in the month of February. So for today's webinar, we will be drawing out for February and March 2021, which will be AirPods Pro, Fitbit Inspire 2, and Touch and Go gift vouchers. Right. I will also share with you the screen on how many people have already referred. Harry, can you see the screen?
Yes, I can.
All right. So this is as of 31st of March. So these are all of the draws. So I hope all of you are here right now because all of you are entitled, whose name is on the screen right now, you are entitled to win the prizes, which is AirPods Pro, Fitbit Inspire 2, and Touch and Go gift vouchers. All right. Okay, so let's get it started. Okay.
Well, so we give 4 prizes today.
Sorry?
4 prizes today.
We're going 3 prizes.
3 prizes. Wow, that's like a lot of money.
All right. Okay, so I've prepared. So as of, I will open up the Excel sheet and wait, this is the, you are seeing my entire screen right now, right?
Yes, I can. Yeah, I'm
Okay.
seeing the.
Wait, let me bring up the screen again. See my screen. Okay. Okay, so you're seeing my screen, right? All right. All right. So these are all of the names that I've just listed out just now. So we have a total of 122 draws. Okay. So as you see, the numbers are the names are aligned alphabetically. So I'm just going to randomly sort it. Excel can, sort it out using a random generator. Okay. So basically, these are the random names. It's random. And then I will Google random number generator. And okay. All right. So how it will work is basically I will key in number minimum is 1. And then as I mentioned just now, 122. So maximum is 122. So when I press this generate button, it will randomly generate a number. And if it's your number, you will be winning our prizes. Okay, so for the first draw, we'll be doing for the Touch and Go gift voucher worth 200 ringgit. Okay, so are you guys ready? So this is the exciting part, okay? All right, so I'm gonna press
Drum
the button.
roll.
Okay, drum roll in 3, 2, 1.
Run.
Number 87. Okay, let's see who is number 87. Lucky number 87. Jusri Ong.
Wow.
Jusri Ong.
Wow.
Congratulations,
Yeah.
Jusri Ong. You just won yourself Touch and Go gift voucher worth 200 ringgit. I'm pretty sure you're here because you asked a few
Yeah, he
questions,
had questions.
Yep, I've just unmuted him. Jusri,
Yeah.
hi.
Thank you very much. Unexpected.
Congratulations.
Thank you. Thank you.
Yeah, congratulations. Okay, so your live planner will be contacting you with the prize. All right. So I think I forgot to mention this now. So basically, we will be the draws is actually cumulative. So like for example, those who gave referrals in the month of January, your names are actually here in February and March, and then also those who actually won in January, you are still entitled to win. But if let's say you've already won this time around, if let's say I were to press again and for example Jusri were to be selected, he won't be entitled for the next prize, right? All right. So for the second one, okay. So the second one, Harry, what's the second one,
this?
Harry? What's the
Is it
second one?
the AirPods Pro, is it?
You want to do the AirPods Pro for the Fitbit Inspire? Which one?
Oh, we go for the Fitbit Inspire first.
Okay, Fitbit Inspire. Okay.
Yeah, we
so
go,
for the
then
Fitbit Inspire, let's
best for the
go. All right. All right. 1, 2, 3, go.
Boom, boom. Ding.
Number 113. Let's see who's number 113. William Ong.
Wow.
William Ong, are you here?
William
Kahiat. William?
Ong Ka Kiat. William Ong Ka Kiat.
Are you here?
If you're here, okay.
Yes, he's in.
All right. Congratulations, William.
How do we
Congratulations.
William? Can you guys see him? Yeah.
I cannot really see. Harry, can you see?
Oh, I see him. Okay. Yeah. Okay. It's on. Yeah, William, you're on. You can talk. We've unmuted you. You can talk if you want to. William, you there?
William, are you there?
He did say yes, thank you, but no voice.
I see. Maybe camera shala. But anyways, congratulations, William. You just won yourself a Fitbit Inspire too. All right. Okay, congratulations. All right. Okay, so for the grand prize,
Congratulations.
for the AirPods Pro, like what I'm actually wearing now is the AirPods Pro. It's worth about, if I'm not mistaken, it's about 900 ringgit currently.
Ooh.
All right, 900 ringgit worth by just referring. All right.
All right.
Okay, so I will generate again. Okay, drum roll, please.
Ding, 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 ding,
Dum,
ding.
dum, 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 dum.
Okay, 1, 2, 3, go. Number 49.
49.
Ooh,
Number 49. Melissa Tan.
wow.
Melissa Tan. Melissa Tan, are you here?
Oh, I see Melissa Tan. I'm allowing her to talk now.
Yes,
Melissa
yes,
Tan.
I'm here.
Hi,
Yeah.
congratulations, Melissa. You
Thank you
just
very
won
much.
yourself an Apple AirPods Pro.
Wow, thank
Congrats,
you.
Melissa.
Congrats,
Congratulations.
Melissa.
Congratulations. How do you feel?
Congratulations.
Huh?
How do
Very
you
happy,
feel?
very happy. I'm using iPhone too.
Oh,
Oh,
okay.
wow.
Wow. So, yeah, that's very convenient. So you can use the Apple AirPods Pro right after this. All right. So, okay, congratulations to all the winners. All right. So we've basically ended the webinar. So so for those who attended this webinar, we have a uh, special contest, not just special contest, a special offer for you whereby if you would, because like what I said, this Wai Ambassador program actually ends in 30th April, and today is actually the 4th of May, right? So what we will do is actually for those who are attending this webinar, we will be extending until the first day of Raya. So if you were to refer to us, we will be giving you one extra lucky draw, right? So which will be done in the next up and coming webinar. And the next webinar, the prize is even bigger. The grand prize is Apple Watch Series 6. That's
Wow.
worth about how much, Casey?
I remember it's about 1,007 plus from last.
2007, yeah.
Wow.
So yeah, if you were to just, it's very simple. You just contact your live planners and you refer to them a person, and then you'll be entitled for the draw, and it's completely random. It's like what I showed you just now. It's completely random, and you stand a chance to win, right?
Yeah, all right.
Okay.
That's great.
All right. So I'll pass it back to you, Harry.
Okay. All right. Thanks, Hafiz, for that. And congratulations to all of the winners. I'm sure you're very happy with your prizes. Congratulations. All right. Thank you so much, everyone, for attending the webinar today. That'll be all for now. I hope to see you all soon in our upcoming webinar, which will be on next month. I hope to see you soon. Take care and stay safe. I see you guys. Bye-bye.
Bye everyone. Stay
Bye
safe.
everyone. Thanks.
Y'all.
Bye.
Bye.